Welcome back, guys. Today we're going to take a look at Trane Technologies, which has had a very strong performance over the past 5 years, up to 140%, definitely outpacing the S&P 500. This is a company that's kind of in that infrastructure space. It provides solutions for HVAC, heating and cooling for homes across basically the entire world. So I guess it's well diversified in that respect. Yeah, infrastructure, housing type of company. Past 5 years, 240%. Their all-time chart looks pretty good. It can be quite cyclical at times, where it drops pretty considerably. But for the most part, it's just straight up and to the right. Yeah, they're up 240%, but they're in terms of their financials, their net income has only increased by about 50%. So there's definitely a lot of multiple expansion going on here, and that might indicate that the company is overpriced at the moment. Their price to earnings ratio is also quite high at 35, and they are a $74 billion company, so quite large at this point. Let's take a closer look at their financials. Yeah, for their revenue growth, it hasn't even been all that stellar. It's been about 5, and then they had some negative years, so probably about 5% a year. But over the past 3 years, it's been 10%. Quarterly, on a quarterly basis, it's about 10 to 12%. I'm not quite sure if we can expect that moving forward or not, but yeah, I would probably expect the revenue growth to taper off a little bit. And in terms of their earnings, it's very consistent. They have very consistent margins. They do buy back some stock, it looks like. Their balance sheet, they have $4 billion in debt, so they do have quite a bit of debt, I guess. Although it's definitely serviceable, it's not too bad. In terms of their cash flow, what are they doing? Yeah, their debt's not too bad, okay. But in terms of what they're doing with their cash, well, they buy back stock and they pay a bit of a dividend, and then I think they do keep some on the balance sheet. No, it looks like they basically pay out everything to shareholders, so I guess that's good for the shareholders. Let's look at the stats here. Their return on invested capital is not that great. Looks like it hovers between 8 and 19%. So it's okay, I guess. 14% is, yeah, it's okay. Gross margin, it's 30%, very consistent. Their net margin has expanded up to about 11%. We're kind of projecting 12% moving forward. Can they keep that up? Maybe not. They might revert back down to that 7 or 8% in margins. But yeah, let's look at what the analysts are thinking. The analysts are projecting 10.5 going to 11.7. That's kind of like a 10% or 11 or 12% increase in their earnings per share, and then their revenue estimate is going to be about 9% growth this year and about 6% moving into 2025. Let's take a look at the stats, take a look at that short percentage, always an important number. The short percentage is only 1.2%, so that's a green flag. It's not bad at all. Let's take a look at the model that I have. Now, remember, they are trading at a 35 price to earnings ratio, so especially for a construction company that seems to have kind of low growth, it doesn't really seem to justify its value right now. Yeah, but I put their estimates up here, their buybacks, net debt of $4 billion, discount rates of 10% because that's the return that I am trying to get for all my stocks, and an exit multiple of 20. Yeah, with them currently trading at 35. I'm not quite sure what the moat is on this business. I mean, they've got competition with other companies in the space, I'm sure. And with being such a low growth business, I don't see why they should justify an exit multiple higher than 20. So we're looking at a growth rate in their earnings of 10 and then slowing down to 8 and 6%. I think that's fair. And in that case, we're looking at a fair share price of between 217 and 234. Probably about 225 would be a good price to get this company at. And in terms of their revenue margins model, I've got their revenue growth at 9%, slowly declining in growth down to 8 and then 5%. It's possible that they keep up that 8% for a while. Maybe we say that they keep up their growth for 8%. Profit margin of 12%. Yeah, they might revert back down to that 9% range, but we'll keep it at 12% for now. Even with these like pretty optimistic assumptions, they are pretty overpriced at the moment. Currently trading at $330 a share. Maybe you expect like a maybe you could get a 5% return. Yeah, pretty close to a 5% return, maybe a 4% return. Yeah, I don't think I would buy this company. Maybe if you're expecting to get about the return that bonds are giving you over the coming years, but I just think that is pretty overpriced at the moment. Maybe we can go back and see, or wait, yeah, maybe we can go back and see what they were trading at back in the day, see what would have been a good price to buy them at. Yeah, because I was coming out at like $200 a share, and yeah, you could have bought them basically a year ago for that price, and now I definitely think they're overvalued at the moment, probably due to multiple expansion. But yeah, that's my thoughts on Trane Technologies. Let me know what you guys think in the comments, and yeah, make sure to hit that like button. Also, if you guys want access to this spreadsheet, it's free. Just check the description in my video, and yeah, I'll see you in the next one.